We got some huge news for stock market investors as the central bank and the Federal Reserve in the United States indicated that they will be cutting interest rates. They did cut interest rates by a quarter basis points and indicated more interest rates are coming. They also gave greater detail about what to expect with inflation, unemployment, economic growth, and interest rates for next year and 2027. I'll talk about some of those details and what it could mean for stock market investors. The central bank Federal Reserve interest rate policy is a complex, very complex thing. I teach a whole class at a university, 16 weeks, 3-hour lectures, and at the end of the whole semester, students are still feeling like they don't know everything there is to know about the central bank. And I would agree, it takes a long time to really get your hands around why and how this thing works, where the central bank controls or tries to control interest rates in the United States and around the world. So let's get into the details, and I'll try to do the best I can in this short video to provide as much detail about what these moves mean for your money and investments overall.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So let's start with the FOMC, Federal Reserve Open Market Committee statement that they released after their meeting today on September 17th. So let's read together here these first two paragraphs. They said that recent indicators suggest that growth of economic activity moderated in the first half of the year. Job gains have slowed and the unemployment rate has edged up but remains low. Inflation has moved up and remains somewhat elevated. So let me break this down a little more. In the first half of 2025, the big change was the new administration in the United States, right? President Donald Trump took office. And some of the biggest moves President Donald Trump initiated were to cut waste in the government spending, a lot of cost cutting in the government. And of course, that leads to job losses and declines in economic activity. But that wasn't the biggest thing. The biggest thing was the change in trade barriers, or the increase in trade barriers, increasing tariffs meaningfully on everyone. Every single United States trading partner, it experienced an increase in trade barrier. Now, those varied and those changed, and all of that also added to the uncertainty to businesses and individuals around the world, not just in the United States, but primarily in the United States. If you were a business owner, President Donald Trump introduced a lot of uncertainty. It wasn't just, okay, your costs are going up by 15% to import goods or 25% to import goods. There was a lot of uncertainty. First, your costs were going up by 15%, then they weren't. They were paused. And then they were going up by 50%. And then they weren't. And they were lowered and they were paused. So it wasn't just an increase in cost. It was also an increase in uncertainty, which is a lot more difficult to handle than an increase in cost. Businesses that have been around know how to handle an increase in cost. It's not something that they haven't dealt with before. But when you're dealing with all of that uncertainty, that's what's more difficult to handle, because you don't know what the policy is going to be, so you can't make the decisions you need to make in order to move forward with your business. So that created a lot of slowdown, a lot of pausing, a lot of decisions that were just pushed down the road. Instead of making the decision today, business owners just said, well, let's see if we can kick the can down the road and make a decision 9 months later or 6 months later when there's more information and there's more certainty. So all of that created a slowdown in economic activity in the United States. Fewer products were created, fewer people were hired, fewer businesses were created, fewer restaurants were open, fewer restaurants opened at second and third location. All of that happened. Furthermore, inflation moved up and remains elevated. So inflation was coming down before the tariffs were announced. Tariffs, remember, make it more expensive for a business in the United States to import goods. So every business is paying more for bringing things in from outside the United States. And I follow 200 or 300 companies. I can't think of one company a company that sells physical goods. I can't think of one company that sells physical goods, even US manufacturers like Ford and General Motors, that doesn't need to import goods from outside the United States. So they were all impacted negatively. They all had to experience an increase in cost. And if they're experiencing an increase in cost, some of that is going to be passed down to the consumer because they can't absorb all of those higher costs. The profit margins are just not high enough to absorb a 15, 25% or 50% increase in their cost. So they had to pass that down to customers. And so price levels increased in the first part of the year. And that's just the beginning. That's just the beginning. Companies are going and planning for more cost increases, price increases in the back part of this year. Companies like Walmart and Costco and others have announced that every week, this is Walmart saying every week for the rest of this year, they expect prices that customers see in stores to go up. So that's happening. And that's causing inflation to go up. Okay, so let's move on. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer term. That's the key statement there. That sentence, the committee seeks to achieve maximum employment and to keep inflation at 2% over the longer run. That's the two goals of the Federal Reserve. That's the only two things that is their job to do, to make sure they can achieve maximum employment and to make sure they can keep inflation at around 2%, not 0%. They don't want 0% inflation because that's too close to negative, and negative is very dangerous for an economy because that delays a lot of consumer spending and business spending, and it goes into this negative virtuous cycle that they don't want to get into. So that's why they've chosen 2% as a safe target that's above zero, but not too large of a number where people are seeing prices going up too rapidly. And these are offsetting factors. You can increase employment by lowering interest rates. When you lower interest rates, it increases employment and it creates more jobs because many things that you buy are dependent on interest rates. Well, I shouldn't say many things, but some very large things like homes and cars are dependent on interest rates because of the monthly payment. If interest rates are lower, your monthly payment on a car and a house is lower, so you're more interested in buying a car or a house. And then there's the trickle down effects, right? If you buy a car, you're going to buy car insurance. The salesman that sold you the car makes money and he's going to or she's going to go out and spend that money. The car dealership makes money. Maybe you buy some accessories for your car. There's all this activity that starts as a result of that purchase of a car or that purchase of a home, right? You need furniture. You want to customize your home. You hire movers, et cetera, right? So you can increase employment by lowering interest rates, but then that causes inflation to go up. If you're more interested in buying a house and your neighbor is more interested in buying a house and everyone is more interested in buying a house, then when you go to buy a house, you're bidding against other people and you overbid. And that's where you have those bidding wars. And that's where prices for houses go up, prices for cars go up. And then you have the trickle down effects and prices go up for a lot of other things. So that's what the Federal Reserve has to keep in balance. They went on to say, uncertainty about the economic outlook remains elevated. That's almost always the case, but it's more than usual. The committee is attentive to the risks to both sides of its dual mandate and judges that downside risks to employment have risen. That's the big difference now. Downside risks to employment have risen. So now, after many, I would say since 2021, when inflation really got out of control as a result of the pandemic, where you had a supply shock, where governments worldwide restricted supply, right? They made it more difficult for businesses to produce things because of all the rules with employment and 6 feet distance and forcing, Cruise ships couldn't operate, theme parks had to close, movie theaters had to close. So there was a supply shock where supply was limited, and they also sent out trillions of dollars into the economy. So people had more money, a lot more money to spend, and there were a lot fewer things you can spend your money on. And so that created inflation that got out of control. And so since then, they've been fighting to get inflation back down to that 2%, which they haven't done yet. They haven't gotten it back down to 2% yet. But now, what they see as a bigger risk is a slowdown in the economy. They see that as a bigger risk now than inflation. Inflation is still not where they want it to be, but now they're seeing a lot of slowdown, right? I mentioned businesses have all but, paused all this activity. They're not hiring, they're not creating new things, and so they're not creating that many jobs. So the unemployment rate is at risk of going much, much higher. And so the Federal Reserve is now more attentive to that risk than the inflation risk. So that's why they lowered interest rates, because they see that as the bigger risk of their dual-sided mandate. They have to always think about the balance. And so right now, the unemployment picture and how bad it's getting is more of a concern for the central bank than the inflation picture, which is still not completely solved, but the unemployment thing is more pressing. So that's why they lowered interest rates today. So furthermore, they talked about the future, and the central bank said that they expect real GDP to be a little bit better than they expected in June. In June, they said that they think GDP in 2025 was going to be 1.4%. They now think it's going to be 1.6%. And the same thing for next year. They thought it was going to be 1.6%, but now they think it's going to be 1.8%. For economic growth, they expect will be better, but they also expect inflation will be higher next year. Remember what I said, it's a dual-sided mandate. So as they focus on decreasing interest rates to boost employment, they now expect inflation to increase. So they raised their inflation forecast for next year to 2.6%, up from 2.4%. So they now expect higher inflation next year, and they also expect lower interest rates next year. In June, they thought the interest rates would end this year around 3.9%. They now think it's going to be 3.6%. And for next year, they thought it was going to be 3.6%, but they now think it's going to be 3.4%. So a lot of changes now the central bank is expecting. So what does this mean for stock market investors? When interest rates are falling, it's usually an increase in prices for all things, assets included. Stocks are part of your asset category. So when interest rates go down, stock prices usually go up. One of the reasons for that is, let's say you have some money saved in a money market account and you were getting 5% on a money market account just for letting your money sit there. A lot of investors felt that was attractive and they just let their money sit in a money market account, zero risk, earning 5%. But if interest rates are declining and your money market account is only giving you 4% and then 3% and then 2%, now as an investor, you're like, I don't know if I want to leave my money in a money market account. I want to earn more on my money, especially as inflation is increasing. If I'm only getting 2% in a money market account, I'm losing to inflation. So I want to move my money into assets, into riskier assets that have the potential to generate more returns, which is where stocks come into play. Stocks have the potential, not a guarantee, to deliver a better return to investors instead of money market accounts, especially as money market accounts and bond rates are declining as a result of central bank policy. So that's the give and take there. Again, I can make a 6-hour long video about the central bank and the Federal Reserve, and you still wouldn't feel like you knew everything there was to know. And I would agree that wouldn't be enough time to deliver everything you need to know about the central bank and their policy. But I tried to condense it as much as I could for you here in this video to try and provide an overview of what it means when the central bank and why they're doing what they're doing and the forces they have to balance and why they don't just, lower interest rates to zero like everyone wants, right? If they lower interest rates to zero, you can refinance your home at lower interest rates. Your monthly payments on a lot of things would be lower. but then you would be paying a lot higher prices. Inflation would get out of control, and you would be complaining that, egg prices are $80 now, and a pound of steak, a pound of beef is $25. And then you would feel the consequences of that lower interest rate policy. So that's what they're balancing, and I hope I explained some of that here in this video. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.